Welcome to the Holistic Accountant Podcast. The aim of this podcast is to demonstrate how accountants must employ a holistic approach to help their clients maximise wealth. It's not just about preparing tax returns. So each week, Mina Abraham and I will discuss topics to help you better understand some of the things your holistic accountant can help you with. Okay, today Mina and I would like to talk about how financial advice and taxation advice intersect. That is, that we believe a holistic approach is the best way to go because there's a lot of factors that are multifaceted. For example, how we distribute business profit will have an impact on how we can invest that profit. So there's a personal investment consideration, there's also a tax consideration and so forth. And we feel like the best way to make that point is really to talk about a particular client that Mina and I have worked on together and how we've dealt with his particular tax planning issues and financial planning issues as a team or as a holistic approach to achieve a really good outcome. Okay, so just by way of background, we've worked with this client for a couple of years. He approached us after selling a business, which means that he had a lot of cash in the bank, a large capital gain, of course, and then also he had entities that some which he continued to trade through and some that weren't trading through, some that had carried forward losses, some that had Division 7A issues, so that is that he's distributed money into a company, but the actual cash hasn't gone into that company. So there was a lot of sort of tax considerations, as well as we had to then work out how we're going to invest his cash. So, Mina, talking about the Div 7A issues, maybe you can talk about how we address them.
Definitely. We find that a lot of accountants don't really have a particular strategy when it comes to distributions. We find that typically the easiest way to minimize tax or is to basically take the profit out of a trust and just dump it in a company and pay the corporate tax rate and then deal with the consequences after. There's no clear strategy on how to use those funds, who actually owns those funds, or what you can do with them. And for this particular client that Stuart is referring to, we actually inherited this large Division 7A problem. And there was particular investments in a trust, and by simply just transferring those investments from the trust into the company, we've essentially eliminated the Division 7A problem, saving probably about $30,000 in tax, Stu?
Yeah, at least annual, yeah. And that's an annual saving too, by the way, of course. So, pretty considerable, and of course that's difficult to identify if you're just acting as the accountant, the client's accountant, and then also probably impossible to identify if you're just acting as the client's financial advisor. But by getting around the table and talking about this particular issue helped us, develop a strategy. Also, Mina, there was we were distributing monies to family members, which is completely legitimate and so forth. But of course, navigating the more recent compliance issues around that was interesting too.
Yeah, definitely. With these recent complexities around distributions, it's really important to not only have a distribution strategy, but correctly implement your distribution strategy. Previously, accountants have gotten away with just basically distributing to family members and not knowing the actual consequences of having those distributions still owing to family members. So it's actually really important to get all your ducks in a row if you are electing to use, your parents or in-laws or relatives or children. It's important that you implement the distributions correctly.
Yeah, that's right, Mina. And of course, then there's some financial planning considerations, because if we're going to distribute a whole bunch of money to a particular family member and we actually want to physically distribute that money, then we need to, if it's invested, we have to divest of it and then make that distribution. So the right hand needs to know what the left hand is doing from a financial planning perspective as well. Now, as we mentioned, the client had some losses in particular entities. So he also was still generating other business income from one business that he retained. So, of course, we want to take into account, being able to utilise those losses but then also, which will save us tax, which is great, but then how are we going to invest the money if, it's trapped inside that entity? So again, it shows, that left hand needs to know what the right hand is doing. And then also, finally, a lot of these, Div 7A losses, all those sorts of structural tax structuring issues kind of informed where and how we're going to invest, the cash that he had. But also we wanted to consider other ownership considerations as well, or take into account other ownership considerations. So it can't just be all tax focused, can it, Mina?
No, definitely not. So, when considering investing in a company, for example, you could potentially lose out on what is called the capital gains discount, or the 50% discount, better known as. So you need to be sure about what kind of investments you actually put in a company structure compared to what investments you put in a trust structure, so that you can benefit the most tax-wise.
And it's about finding a balance. I'm not sure that there's a perfect answer in some of these things. That is an answer that ticks all the boxes, that optimises both investing and tax saving and so forth. But it's about finding a balance. And I guess, this is a really good client example to sort of show how if you have the same team working on the one client, you can find that balance much better than what you can if you don't have that sort of holistic approach. Okay, so hopefully that gives you a bit of a taste for how we go about helping clients and how hopefully your financial advisor and your accountant are hopefully working together to achieve those outcomes.